This strategy is designed to filter out weak or average trade setups, focusing only on signals that offer the highest profit potential. It automatically eliminates low probability trades, so you're left with only the best opportunities. Alright, let's dive straight into the analysis. Have you ever wondered why banks and institutional traders keep winning in the market, while retail traders struggle to stay afloat? Well, it all comes down to one thing: discipline. Banks and institutional traders don't just gamble, they follow advanced, battle-tested strategies with laser-sharp precision. And in this video, I'm about to reveal one of my best-kept secrets, a strategy that could completely change the way you trade. The strategy I'm about to show you is designed to identify high-accuracy trading signals with massive profit potential. So, let's dive right in and break this down step by step. Let's get started. Let's dive straight into this strategy by breaking down every single indicator we're using, so you fully understand how it works. First up, we've got moving averages. Why do we use them? Simple. Moving averages help us confirm the trend in the market. And here's the deal. The safest, most profitable, and highest potential trades come from trend-following strategies. That means we're not trying to fight the market. We're going with the flow, riding the momentum that's already there. Now for this strategy, we're using 3 key moving averages: 100-period EMA, 34-period EMA, 5-period EMA. So how do we read them? Well, I'm pretty sure you already know how to interpret a 3MA setup like this. But let's make it crystal clear. If the 34-period EMA is above the 100-period EMA, the market is in a bullish trend. If the 34-period EMA is below the 100-period EMA, the market is in a bearish trend. And the 5-period EMA, that's our entry signal indicator, our trigger to jump into the trade. I know many of you are already familiar with these moving average rules, but if you're not 100% confident yet, don't worry. I'll walk you through a real case example to break it down step by step so you can fully master this fundamental trading rule. Take a look at this chart. It's crystal clear the 34-period EMA is above the 100-period EMA, and both lines are pointing upward. What does that tell us? We're in an uptrend. The market is bullish. Now, check this out. Price was climbing, but then it started pulling back. That's a classic market correction, and here's something important to notice. During this phase, price tends to close below the 5-period EMA. But here's where things get exciting. When price finally closes above the 5-period EMA, that's our buy signal. That's the moment traders look for, and as soon as the next candle opens, that's our entry point for a buy trade. Simple, effective, and powerful. Now, let's split the script and look at the opposite scenario. Take a look at this chart. The 34-period EMA is clearly below the 100-period EMA, and both lines are pointing downward. What does that tell us? We're in a downtrend. The market is bearish. Now, check this out. Price was dropping, but then it started to climb back up. That's a temporary pullback. And here's something crucial. During this phase, price often closes above the 5-period EMA. But here's the key moment. When price finally closes below the 5-period EMA, that's our sell signal. That's our opportunity. And as soon as the next candle opens, that's our entry point for a sell trade. Sounds simple, right? But hold on. This is just the basic rule. You can't just enter the market every time this happens, or you'll put your trading capital at serious risk. We need filters and additional conditions to confirm high-quality signals. And that's exactly what we're going to cover next, so you can trade smarter, not riskier. Let's talk about the market structure indicator. In this strategy, we're using the zigzag indicator, and let me tell you, with the right settings, even if you're a beginner, you can easily identify the current market structure. And this is huge because market structure plays a critical role in achieving high accuracy entry signals. In fact, since we base part of our market analysis on structure, our entry probability skyrockets compared to just relying on signal confirmation alone. Now, let's break it down. Here's the fundamental principle of market structure. Bearish market, the sequence is high, low, lower high, lower low, lower high, and lower low. When you see this pattern forming, the market is clearly in a downtrend. Bullish market, the sequence is low, high, higher low, higher high, higher low, and higher high. Spot this structure. That means the market is in an uptrend. Sounds simple, right? This is just the foundation. Markets can move in unpredictable waves, and as a trader, you need to develop the skill to read these shifts accurately. Just take a look at this case right here. Pay close attention. This might be a game changer for you. Look at this chart. Focus on this market structure. At first glance, you can clearly see that the market is in a bearish trend. But then, boom, the price suddenly breaks above the previous high. Now, a lot of beginner traders immediately assume this is a break of structure and jump to the conclusion that the downtrend has officially flipped into an uptrend. But here's where they go wrong. Never assume a trend reversal too early. Instead, here's what you need to do. Wait for the next wave. Watch closely. Does the zigzag indicator form a higher low? Or does the price drop even lower than the last swing low? If a higher low forms, that's your signal that the market could be shifting to a bullish trend. But if the price continues dropping past the previous swing low, that means the bearish trend is still in play. This is the correct way to analyze market structure, and mastering this will be a game changer for your trading journey. Understanding market structure is crucial. You'll need this skill every time you analyze price movement. Now, I assume you've fully grasped trend analysis using moving averages and market structure. So, let's take things to the next level. It's time to break down market analysis using the CCI indicator. Let's go. If you're interested in the CCI indicator, you're in for something powerful. This is one of the most well-known and widely used indicators in technical analysis. But today, we're zeroing in on the most essential part: how to combine the CCI indicator with moving averages and zigzag to create a high probability trading strategy. And today, I'll show you exactly how it fits into this strategy. While there's a lot you could explore with CCI, to keep things straight to the point, we'll focus on how it works as a supporting indicator to help us pinpoint precise entry signals with confidence. First, let me show you how to read the CCI indicator to identify those high probability entry signals. Take a look at this. On the CCI indicator, there are 3 key levels you absolutely need to know: -100, zeros, +100. These are critical levels for spotting high probability trade setups, where the potential reward is significantly larger than the risk you're taking on each entry. Here's how we analyze it. 1. Bullish trend: when to enter a buy trade. If the market is already in a bullish trend, you don't want to jump in right away. You wait for the market to pull back and weaken. This happens when the CCI line drops below -100, signaling that the market is temporarily oversold. Now, here's the key part. If the CCI line reverses back up and crosses above the 50 level, or even better, breaks above +100, that's your valid buy signal. But what if the CCI doesn't drop below 900 during the pullback? Simple. We ignore that setup. Trades taken in a shallow pullback tends to have lower profit potential, so we wait for the right conditions. 2. Bearish trend: when to enter a sell trade. Now, if the market is in a bearish trend, we do the opposite. You wait for the market to rally into overbought conditions, which happens when the CCI line moves above 100. Then, if the CCI line reverses downward and breaks below 50, or even better, when the CCI line drops below -100, that's your valid sell signal. Again, if the CCI doesn't reach above +100 before reversing, we skip the trade because weaker pullbacks often mean weaker trade setups. By using the CCI indicator, traders don't have to memorize hundreds of price action patterns. However, if a strong price action pattern aligns with our CCI-based signal, that's even better. It gives us more confidence that the trade has a higher probability of success. Let me show you exactly why this strategy is so powerful and why the signals it generates are the ones that successful traders actively seek out. We're going to break it all down from market movement analysis to the underlying logic behind it. Let's start with a bearish market analysis. Take a look at this chart. You can clearly see, but the market is in a short-term bearish trend. It's obvious, undeniable, and right in front of us. But here's the key. I'm going to walk you through exactly how this strategy works so you fully understand it. This strategy is designed to filter out weak or average trade setups, focusing only on signals that offer the highest profit potential. It automatically eliminates low probability trades, so you're left with only the best opportunities. Alright, let's dive straight into the analysis. First, we need to examine the market structure that has already formed in this price movement. To do that, we're using the zigzag indicator. But here's something critical you must adjust as if you want it to accurately map out the market structure the way I'm using it in this video. If you stick with the default settings, the indicator won't be as precise and you won't get the same level of clarity. Looking at the market structure formed by the zigzag indicator, we can see one thing very clearly. The market is in a well-defined, readable pattern, and that's a huge signal that any trade setup forming here is highly accurate. Now, this is where things get interesting. These market signals are something every trader should understand, yet most amateur and beginner traders completely overlook them. Take a close look. You can clearly see this high, followed by a lower high, and then another lower high. The market is moving in a predictable wave pattern, making it easy to read. Exactly what we want, right? But here's the key. If the zigzag indicator isn't mapping out the market structure properly, don't force it. Instead, move on and find another market where the zigzag can clearly outline the structure, because clarity is everything in trading. Now, it's time to move our analysis forward and focus on the moving averages, specifically the 34-period EMA on the 100-period EMA. Right here, we see something crucial, the 34-period EMA crossing below the 100-period EMA. And that's our second confirmation that the market is in a strong bearish trend. Now let's break it down. The 100-period EMA is one of the most widely used EMAs among professional market analysts. That means support and resistance levels based on the 100 EMA are highly significant because they reflect the collective view of the most influential traders and institutions, shaping the market trend. Then, we have the 34-period EMA, and this one is key. We use it to define short-term trend reversals within the larger market movement. But why 34? Because this period reacts exceptionally well to price action, giving us clearer market signals. And here's an important insight. If we combine the 34-period EMA with the 100-period EMA, guess what? The 50-period EMA naturally falls right in between. This creates a dynamic trend zone, helping us confirm momentum shifts with even more precision. Since we're dealing with a bearish market, the area between the 100-period EMA and the 34-period EMA acts as a strong resistance zone. And what are we waiting for? We want to see this bearish market enter a phase of exhaustion, pushing prices back up into this resistance area, right between the 100 EMA and the 34 EMA. And look at this chart. Exactly that is happening. The prices climbed up into the resistance zone, signaling that this bearish trend is temporarily weakening. The market has been selling off for a while, and now we're seeing a pullback into this key resistance area. So does this mean we should jump in and place a sell trade right away? Not yet. This setup alone isn't enough to confirm a high probability entry. We need one more key confirmation before we act. That confirmation comes from the CCI indicator. If the CCI line is above 100, it tells us that this price rally has stretched high enough into the resistance zone. And if we then get a sell signal, that's exactly the kind of high probability trade we want, because what happens next? The price often plunges deep, offering maximum profit potential with minimal stop-loss risk. Now, the big question: when is the perfect moment to execute the sell trade? The answer: as soon as the CCI line drops from above 100 down below 50, or even bet at below -100. Just like in this example, once the CCI starts dropping, we immediately pull the trigger on the sell entry at the open of the next candle. So, where's the best place to set your stop loss? This strategy identifies two optimal locations, one above the nearest swing high, two above the 100-period EMA. In this case, we're placing our stop loss above the nearest swing high. Why? Because it's not too far from our entry, yet still gives enough breathing room for price action to continue its bearish trend. And then, boom, the price drops fast, locking in a massive profit. Simple, right? Yes, it's straightforward, but here's the catch. You must stay disciplined and follow the trading rules I just explained. Now here's something critical. These high-probability entry signals don't appear often. And that's exactly why this strategy is so powerful. It filters out weak setups, focusing only on trades with huge profit potential. This is the kind of signal that institutional traders love. Why? Because it keeps trading simple. They don't need to chase the market every second. But when a signal does appear, it delivers big, high-reward opportunities. Alright, now let's move on to a buy entry example in a bullish trend. Take a look at this chart. You can clearly see that the market is in a short-term bullish trend. It's obvious, undeniable, and right in front of us. So let's dive into our analysis right here. First, we examine the market structure that has formed. To do that, we're using the zigzag indicator. And look at what it reveals. The market is moving in a well-defined, readable pattern. This is a strong early sign that any trading signal forming here has a high probability of accuracy. Now let's break it down. You can see this low followed by a higher low and then another higher low. The market is forming clear, structured waves, making it incredibly easy to read. That's exactly what we want, right? But here's the key. If the zigzag indicator isn't clearly mapping out the market structure, you shouldn't forfeit. Instead, move on and find a market where the zigzag can accurately define the structure, just like I'm showing you here. The first condition is met. Now we move on to the next step, analyzing moving averages, specifically the 34-period EMA and the 100-period EMA. Right here we see a critical confirmation. The 34-period EMA has just crossed above the 100-period EMA. And that's our second confirmation that the market is officially in a bullish trend. As I've mentioned before, the 100-period EMA is one of the most widely used EMAs among professional analysts. That's why support and resistance levels based on the 100 EMA are so important. It reflects the collective sentiment of the most influential traders and institutions who drive the market. Now here's where it gets interesting. When we combine the 34-period EMA with the 100-period EMA, guess what? The 50-period EMA naturally falls right in between. And that's huge. The HAR50 EN is another favorite among institutional traders and market makers, making the space between 34 and 100 EMAs a highly significant trading zone. Think of this zone like the Kumo cloud in Ichimoku, but with a different configuration, one that's rooted in the trading psychology of dominant market participants. This strategic EMA setup helps us align with the major forces shaping market trends and gives us a clear-edged ability to drop in high-probability trades. Since we're in a bullish market, the area between the 100-period EMA and the 34-period EMA acts as a strong support zone. And what are we waiting for? We want to see this bullish market enter a phase of exhaustion, pulling back down into this strong support area right between the 100 EMA and the 34 EMA. And look at this chart. Exactly that is happening. The price has dropped right into this key support zone, signaling that this bullish trend is temporarily weakening. The market has been pushing higher, but now we're seeing a healthy retracement into this critical support level. So, does this mean we should jump in and place a buy trade immediately? Not yet. This setup alone isn't enough to confirm a high probability entry. We need one more key confirmation before we act. That confirmation comes from the CCI indicator. If the CCI line is below 900, it tells us that this price drop has stretched low enough into the support zone. And if we don't get a buy signal, that's exactly the kind of high probability trade we want. Because what happens next? The price often skyrockets, offering maximum profit potential with minimal stop-loss risk. Now the big question, when is the perfect moment to execute the buy trade? The answer? As soon as the CCI line moves up from below -100 to above 50, or even better above +100. Just like in this example, once the CCI starts rising, we immediately pull the trigger on the buy entry at the open of the next candle. Where should you place your stop loss? In this case, we're placing the stop loss below the 100-period EMA. Why? Because this is the furthest recommended stop loss level based on this strategy. And even though it's the widest stop placement, it's still within a reasonable distance, keeping our risk controlled and manageable. And then, boom, the price surges upward with momentum, delivering a massive profit opportunity. Sounds easy, right? Well, it is. But there's one crucial rule. You must stay disciplined and follow every single trading rule I've explained in this video. Now here's something important. These high probability entry signals don't appear frequently, and that's intentional. This strategy is designed to filter out weak setups, focusing only on trades with massive profit potential. And that's exactly why institutional traders and big players love this strategy. It keeps trading simple and efficient. They don't need to constantly chase the market. But when a signal does appear, they have the opportunity to capitalize on huge profits while keeping risk relatively low compared to the potential reward. Here's another powerful setup example. Take a look at this chart. First, a zigzag indicator clearly maps out a bullish market structure. Then the uptrend starts losing momentum, pulling back into the support zone between the 34-period EMA and the 100-period EMA. Notice how the 34-period EMA stays above 100-period EMA. That's exactly what we want to see in a bullish setup. At the same time, the CCI indicator drops below 9/100 chart, signaling that the pullback has reached an extreme level. And now, as the CCI line climbs back above 50, or even better above 100 halt, this is where you execute your buy entry, setting your stop loss just below the nearest swing low. And then, boom, the price explodes upward. Now, let's flip to a bearish example. To check out this chart, this time the zigzag indicator clearly defines a bearish market structure. The price drops, weakens, and then pulls back up into the resistance zone between the 34-period EMA and the 100-period EMA. Here, the 34-period EMA is positioned below the 100-period EMA, confirming a strong downtrend. Meanwhile, the CCI indicator shoots above 100, signaling that the pullback has reached exhaustion. As soon as the CCI line falls back below 50, or even better, below -100 chart, this is your sell entry confirmation stop loss above the 100-period EMA. And then, boom, the price plummets. And look at this, another perfect entry opportunity. You take a second sell trade, setting your stop loss just above the 100-period EA, and then the price drops hard, deal another huge profit. Yeah, Yet another example, this setup works consistently. Here's another chart showing the same bearish setup. The zigzag indicator confirms a strong downtrend, price pulls back into the ENA resistance zone, and the CCI spikes above 100. Then, as the CCI line reverses below 50 or -100, that's your sell entry trigger. Stop loss above the 100-period EMA, and again, boom, price crashes down. And right here, another perfect secondary sell entry, this time with a stop loss above the nearest swing high. And just like before, boom, price drops aggressively, delivering yet another winning trade. Now, take your market analysis to the next level. I believe that every single example I've shown you today has given you a crystal clear understanding of how powerful this strategy is. I know for a fact that this video is exactly what you need to take your market analysis skills to the next level. And watch how your understanding of the market becomes sharper than ever. I'll see you in the next video.